Welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into a topic that doesn't always get the attention it deserves, but is absolutely crucial to long-term trading success. We're talking about risk management. And I know when people hear the term risk management, they sometimes tune out. But if you're trading without a risk management plan, you're not just risking your capital, you're gambling with your future in the markets. Let me start by saying this. In trading, everyone loves to talk about profits, right? The wins, the high return trades, the overnight successes. But ask any seasoned trader and they will tell you real success doesn't come from chasing profits. It comes from protecting what you already have. Capital preservation is the name of the game, especially when you're just starting out or trading with limited funds. And this is exactly where risk management becomes your greatest asset. When traders fail, it's rarely because they didn't have good ideas. It's because they didn't manage their risk. They went in too heavy on one trade. They didn't set a stop loss. They kept adding to a losing position. Sound familiar? These are some of the most common mistakes that destroy accounts. The worst part? They're entirely avoidable with a sound risk management framework. Let's look at why risk management matters even more than you might think. The market, as we all know, is unpredictable. Strategies, no matter how well tested, don't work 100% of the time. That's just the reality. You can do all your analysis, execute a trade exactly as planned, and still end up on the losing side. What makes the difference between a trader who survives and one who doesn't is how much they lose when the trade goes against them. That brings us to stop loss orders. These are your first line of defense. A stop loss is a predetermined exit point that closes your trade when the price moves against you beyond a certain threshold. It protects you from letting a bad trade turn into a disaster. For example, let's say you buy a stock at $100 and set a stop loss at $95. If the trade fails, you lose $5 per share. You don't panic, you don't hesitate, the trade exits automatically. This small controlled loss is manageable. But without that stop loss, that $5 can turn into $10, then $20, and suddenly you're holding a bag that never recovers. A good rule of thumb for beginners is to risk no more than 1 to 2% of your total capital on a single trade. If your account is $5,000, that means risking between $50 and $100 per trade. It might not sound like much, but remember, trading isn't about hitting home runs. It's about staying in the game long enough to let your edge work. Think of your capital as your fuel. Without it, you're going nowhere. Now let's talk about position sizing. This is one of the most overlooked yet critical parts of risk management. Position sizing means determining how much of an asset you should buy or sell based on your defined risk per trade. It's math-based, not emotion-based. And it ensures that no single trade has the power to wipe you out. Say you want to risk $100 on a trade, and the difference between your entry price and stop loss is $2. Using a basic formula, you divide your risk amount by that $2 difference, which gives you a position size of 50 units. That's 50 shares if you're trading stocks. Keeping your trades proportional to your account size prevents you from overexposing yourself to any one setup. And what about diversification? You've heard the saying, don't put all your eggs in one basket. Diversification means spreading your risk across multiple assets or markets. If one of your trades or investments doesn't work out, another might balance it out. Especially if you're holding positions across asset classes like stocks, ETFs, Forex, or even crypto, you reduce your exposure to any single source of risk. Diversification can also mean varying your time horizons. Maybe you're day trading one asset, but swing trading another. Mixing time frames keeps your capital working while managing overall exposure. But perhaps the most important mindset shift is this: focus on capital preservation. A lot of beginner traders focus on how much they can make. Professional traders focus on how much they can afford to lose. That shift in thinking changes everything. It keeps you from revenge trading. It keeps you from doubling down on a bad trade. It makes you pause before entering risky setups. Capital preservation means you're always thinking about longevity. So what are the common pitfalls? First, trading without a stop loss. One mistake like that can wipe out a large part of your account. Second, over-leveraging. This is especially dangerous in Forex and crypto markets where leverage is easy to access but risky to use. Third, trading too large a position. It might feel good to go big or go home, but it's often a fast track to emotional trading and panic-driven decisions. Finally, overtrading. Taking too many trades in a short span of time doesn't mean you're being productive. Often, it means you're chasing the market. If you want to get better at managing risk, start by journaling your trades. Write down your entry, exit, stop loss, and most importantly, the reason for the trade. Note your emotions before and after. Over time, this journal becomes your mirror. You start spotting patterns, not just in price action, but in your own behavior. Set clear risk parameters before each trade. Use calculators to figure out your position sizes. Adjust your stop losses based on volatility. And remember, no plan is set in stone. Review your performance monthly. See what worked. See what didn't. Adapt and grow. Trading is a skill, and like any skill, it gets better with disciplined practice. Before we wrap up, I want to leave you with this. Trading is not about being fearless. It's about respecting fear. It's about knowing the risks and taking them only when you've planned for the worst case scenario. That's what professionals do. That's how they stay in the game long term. And if you're new or still refining your approach, check out crystalballmarkets.com. It's a trading platform designed with risk management in mind. With tools for setting stop losses, calculating position sizes, and learning from your trades, it's an ideal space to start building the right habits. Also, be sure to tune into the Crystal Ball Markets podcast, where we talk about real-world trading strategies, mindset development, and how to stay disciplined in unpredictable markets. Because at the end of the day, discipline and risk control are your real edge. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia, and I hope this breakdown on risk management helps you tighten up your trading game. Remember, don't just trade to win. Trade to last.